Assalamualaikum. Today our group will present about factors that affecting exchange rate of Singapore dollar. My name is Muhammad Amir bin Muhammad Ludin and my group member is Muhammad Majdi Ilman bin Mahdawi, Syafiq Daniel bin Zurita, Muhammad Husnul Hirhan bin Muhammad Rasidi.
Hello everyone, today I want to share some background of Singapore, a fascinating country in Southeast Asia. For the geography, Singapore is a small island nation located at the southern tip of the Malay Peninsula. Despite its size, it plays a significant role in the region. The capital of Singapore is also called Singapore, making it a unique city-state. In Singapore, multiple languages are spoken. The four official languages are English, Malay, Mandarin, and Tamil. This reflects the country's rich multicultural society. As for now, the current president of Singapore is Tharman Shanmugaratnam. He plays a vital role in the government and represents the diverse interests of the people. Singapore is famous for its vibrant multicultural society. There are many iconic landmarks you can visit, such as Marina Bay Sands, the Merlion, and Gardens by the Bay. The country is also known for its diverse festivals. You can experience celebrations like Chinese New Year, Deepavali, and Hari Raya Aidilfitri, each showcasing its unique cultural heritage. Singapore is not just a small island. It is a thriving, multicultural city-state with a rich history and vibrant culture. Next, I want to share the history of money in Singapore, from before independence to today. Before Singapore became independent, which is before 1965, it was part of the Straits Settlement. At that time, the currency used was the Straits dollar, which was also used in Malaysia and Brunei. In 1963, when Singapore joined Malaysia, they started using the Malayan and British Borneo dollar. After independence in 1965, Singapore separated from Malaysia. It became an independent country. They set up the Board of Commissioner of Currency Singapore, or called as BCCS, to manage their money. In 1967, Singapore began issuing its own money called the Singapore dollar or SGD. At first, it was linked to the British pound and later to the US dollar. During the 70s and 80s, the Singapore dollar was managed using a mix of different currencies. The Monetary Authority of Singapore introduced new banknotes and coins with better design and security feature. In 1987, a new series of coins was released. These coins feature designs that celebrate Singapore's identity, like the Merlion and local flower. In 1999 to 2000, Singapore released a new series of banknotes called the Portrait Series. They show Yusof Ishak, Singapore's first president, and had new security features to prevent forgery. In 2013, Singapore introduced a new $2 polymer note and switched to polymer for all notes. These notes are stronger and more secure. Today, the Singapore dollar or SGD is a strong and popular currency. Singapore continues to improve its money, designed for better security and strength. Next, I will tell you about Singapore's major export and its role in global trade. For the major exports, Singapore exports many important products. Some of the biggest ones are refined petroleum. Refined petroleum is oil that has been processed. Second is integrated circuit. Integrated circuits are tiny chips that use in electronics. Third one is pharmaceuticals. Pharmaceuticals are medicines and medical products. And last one is machinery. This includes various types of machines and equipment. The most common countries that buy Singapore's export are China, United States, Malaysia, and Indonesia. And the export value is very high. In 2022, Singapore's total export value was about 625 billion of USD. For the global trade hub, this high export value makes Singapore one of the leading exporters in the world. It is a key global trade hub connecting many countries. Now, I will share information about Singapore's major imports and its role in global trade. For the major imports, Singapore imports several important products. Some of the biggest imports are crude petroleum. Crude petroleum is unprocessed oil. Second is electronic. This includes devices and components like smartphones and computers. And the third one is machinery. There is various types of machines and equipment, and the last one is medical equipment, which is tools and devices used in healthcare. The main countries that supply Singapore's imports are China, United States, Malaysia, Japan, and Indonesia. In 2022, the total import value for Singapore was about 610 billion USD. This high import value makes Singapore one of the most top importers in the world. It shows how important Singapore is as a major trading hub.
Now, I'll be continuing today's presentation by discussing the factors that affect the exchange rate of Singapore dollar. First and foremost will be the inflation rate. In 2019, inflation stood at approximately negative 0.5%, marking a period of deflation. This happened because weak consumer demand and an excess supply of goods led to falling prices, which can slow down economic activity and discourage investment. Moving into 2020, deflation deepened further to negative 1.0%, largely due to the COVID-19 pandemic. Lockdowns, reduced consumer spending, and declining energy prices pushed inflation into negative territory. Governments and central banks responded by implementing large-scale stimulus measures to support the economy. By 2021, the economy showed signs of recovery, and inflation rebounded to 1.0%. Increased demand, global supply chain constraints, and government stimulus programs contributed to price growth. As businesses reopened and production resumed, supply shortage led to gradual price increases. However, in 2022, inflation surged to 6.5%, reaching its highest level in this period. This was driven by global supply chain disruptions, surging energy prices, and labor shortages. The rising cost of raw materials and transportation pushed overall prices higher, forcing central banks to take action by tightening monetary policies. In 2023, inflation started to ease but remained high at 5.0%. Some price pressures persisted due to lingering effects of earlier economic shocks. Delayed impacts of monetary policies, wage growth, and price increases in key sectors like food and housing keep inflation elevated despite efforts to bring it down. Finally, in 2024, inflation declined to 3.0%, signaling a return to more stable price levels. Tighter monetary policies, improved supply chain conditions, and moderating energy costs contributed to this downward trend. These indicated that the economy was stabilizing and moving towards sustainable inflation level. Let's move on to the unemployment rate. In 2019, the unemployment rate remained stable at 2.3%, indicating a strong labor market with steady economic growth and job opportunities. However, in 2020, unemployment rose to 3.0% due to the COVID-19 pandemic, which led to widespread business closures, layoffs, and reduced hiring. The global economic downturn during this period created uncertainty, affecting both employers and workers. By 2021, as recovery efforts took effect, the unemployment rate declined to 2.7%. Government stimulus measures, economic reopening, and increased consumer demand helped business recover, leading to job creation. In 2022, this trend continued and unemployment fell further to 2.1% as businesses expanded, hiring increased, and overall economic conditions improved. By September 2023, the labor market had strengthened further, bringing the unemployment rate down to 1.9%. This decline reflected strong economic performance, increased workforce participation, and higher demand for labor. Finally, in the third quarter of 2024, the unemployment rate remained steady at 1.9%, signaling sustained economic stability and continued strength in the job market. Next, average manufacturing PMI. In 2019, economic growth was moderate early in the year but later slowed down due to trade tensions, particularly between the US and China. These disputes led to uncertainty in global markets, affecting business confidence and investment. In 2020, the COVID-19 pandemic caused a sharp economic decline, disrupting industries worldwide. Lockdowns, travel restrictions, and reduced production severely impacted manufacturing and trade, leading to a global recession. By 2021 and 2022, economic activity started to recover, supported by rising global demand and the reopening of businesses. Increased consumer spending and government stimulus measures helped many economies regain stability. However, in 2023 and 2024, economic performance became unstable, influenced by inflationary pressures, changing consumer demand, and ongoing supply chain disruptions. These challenges created uncertainty for businesses and policymakers, making economic recovery uneven. Following that, the exchange rate. In 2020, the exchange rate rose, indicating that the SGD weakened as more of it was required to purchase $1. This was primarily due to economic uncertainty and capital outflows during the COVID-19 pandemic, which affected investor sentiment and led to increased demand for the US dollar as a safe haven. By 2021, the exchange rate declined, signaling that the SGD gained strength relative to the USD. This was due to economic recovery and a rebound in investor confidence, which encouraged investment in the Singapore dollar and supported its appreciation. However, in 2022, this trend reversed, with the SGD weakening again as the exchange rate spiked. This shift was largely driven by global inflation concerns and tighter US monetary policies, which strengthened the USD and led to greater demand for the US dollar in global markets. In 2023, a sharp drop in the exchange rate suggested a significant recovery or strengthening of the SGD. This could be attributed to monetary tightening by Singapore's central bank and improved economic stability in the region, which boosted the demand for the Singapore dollar. Finally, in 2024, the exchange rate leveled out and showed stability. This period of stability reflected a balanced economic environment with reduced volatility and a steady outlook for both the SGD and the US dollar. Lastly, annual growth rate. In 2019, Singapore's growth rate fell into negative territory, which was likely due to global trade tensions, particularly in the US-China trade war. These trade disputes disrupted international trade and hurt business confidence, leading to slower growth during that period. The economy experienced a strong recovery the following year, with the growth rate peaking at 8 to 9% in 2020. This rebound was largely driven by government support through stimulus measures, along with the easing of COVID-19 restrictions, which allowed businesses to reopen and consumers to return to economic activity. As we moved into 2021 and 2022, growth began to slow but remained positive. This slowdown was primarily due to inflationary pressures and supply chain issues, which affected production and distribution. Despite these challenges, the economy managed to sustain positive growth during these years. By 2023 and 2024, the growth rate steadied at around 2%, supported by strong demand in key industries such as finance and technology. These sectors remained resilient, helping maintain economic stability despite ongoing global challenges.
Okay, next, I'm going to talk about descriptive statistics slide. This analysis of Singapore's exchange rate from 2019 to 2024 shows a mean value of 1.3567 SGD compared to USD, with a maximum of 1.3800
indicating a weaker SGD at its peak. The low standard deviation 0.0197 and variance 0.0004 suggest minimal fluctuation, making the exchange rate relatively stable. The slight right squeakiness 0.456 and flat kurtosis -2390 indicate fewer extreme change, reinforcing the stability of the exchange rate over time. Okay, next I'm going to talk about linear regression slide. The regression analysis show a strong correlation R equals to 0.912 between exchange rate and economic factors, like PMI, unemployment, inflation, and growth rate. YR2 equals to 0.832 suggests that 83.2% of exchange rate variation can be explained by these factors. The adjusted R2 dropped significantly to 0.158, indicating weaker predictive accuracy despite the low standard error 0.0180, making the prediction precise. The F change 1235 suggests that no single factor has a dominant impact on the exchange rate. Okay, next we have ANOVA analysis script. This analysis presents the result of ANOVA test examining the relationship between Singapore's exchange rate SGD compared to USD and several economic indicators, including average manufacturing PMI, unemployment rate, and inflation rate. The dataset consists of 6 observations and the F-test value is 1.235, which is exceed the 5% significance threshold. Since the p-value is 0.581, which is above 0.05, we fail to reject the null hypothesis, indicating that the independent variable do not significantly explain the variance in the exchange rate. Okay, next slide we have coefficient analysis slide. The coefficient table provides detailed statistical values for the independent variable affecting Singapore exchange rate. The p-values for the inflation rate 0.379, annual growth rate 0.345, unemployment rate 0.388, and average manufacturing PMI 0.533 are all above the 0.05 significance level. This suggests that none of these variables have a statistically significant impact on the exchange rate, reinforcing the finding from the ANOVA analysis. Thank you.
How economic indicator affect SGD-USD? The exchange rate between SGD and USD shift with key economic factor. Inflation, negative 0.128. Higher inflation may slightly weaken the SGD. Unemployment, 0.415. Rising unemployment could strengthen the SGD. Growth, negative 0.623. Stronger economic growth tend to appreciate the SGD. Manufacturing PMI, negative 0.266. Better manufacturing performance may boost the SGD. While not absolute, this trend offers insight into currency movement. Stay informed. My name is Muhammad Amir bin Muhammad Ludin. Now let's discuss the solution how Singapore manage its foreign exchange reserve and the impact on Singapore dollar SGD. The Monetary Authority of Singapore (MAS) play a crucial role in adjusting foreign exchange reserves to influence the value of SGD. First is increasing reserve. MAS can purchase foreign currency to boost its foreign exchange reserve. This is not only strengthen investor confidence but also demonstrate effective currency management. Second is stabilizing the Singapore dollar. If the Singapore dollar depreciates, MAS can step in by buying Singapore dollar using its reserve. This increases demand for the currency and helps strengthen its value. Third is enhancing investor confidence. Maintaining a strong reserve reassures investors and support economic stability, making Singapore a more attractive destination for business and investment. Through this strategy, MAS ensures that SGD remains stable, supporting Singapore economy in ever-changing global financial landscape. Now, let's talk about how Singapore adjusts its monetary policy to manage inflationary pressure. The Monetary Authority of Singapore (MAS) play a key role in implementing strategy to maintain price stability and economic growth. Here how. First is tightening the money supply. When the inflation is high, MAS can raise interest rates to reduce borrowing. This lowers consumer spending and investment, helping to cool down the economy and stabilize price. Second is open market operation, OMO. To control inflation, MAS can sell government securities, which absorb excess liquidity from the market. Conversely, during deflation, MAS can buy securities to inject liquidity, encouraging spending and economic activity. Third is managing the money supply. MAS can also adjust bank reserve requirements. By increasing reserve requirements, banks have less money to lend, limiting the amount of money in circulation and helping to control the inflation. Through this monetary policy tool, MAS ensure that inflation remains under control while supporting sustainable economic growth. In conclusion, the Singapore dollar has undergone significant changes since its introduction. After gaining independence in 1965, Singapore replaced the Malaya and British Borneo dollar with the Singapore dollar, marking the start of its rapid economic development. Over the years, Singapore's strategic location as a global financial hub and its thriving export industry have played a crucial role in its growth. The country's smart trade policy, along with investment in technology and infrastructure, have positioned it as a leader in global trade, finance, and innovation. The value and stability of the Singapore dollar are closely linked to key economic factors such as GDP, inflation, interest rate, and foreign direct investment (FDI). To maintain stability and the growth, the Monetary Authority of Singapore (MAS) carefully manage the country's monetary policy, ensuring a strong and resilient economy. Through strategy, reserve management, and policy adjustment, MAS not only preserve the value of the Singapore dollar but also enhance investor confidence, reinforcing Singapore economic resilience and global competitiveness. With this strong foundation, Singapore continues to thrive as one of the world's most stable and dynamic economies in the world. That's all from our group about Singapore dollar exchange rate. Thank you, Sir Zaihan.